got to talk to Dan. And we had this great first conversation, and I've been following all of his work since. And then when he agreed to be on the panel, I read his book. It is the best investment book I've ever read. And I will ask Dan to tell me a little bit about his background, what he's found and seen. And I think the most interesting thing, we've heard a lot of people who have kind of learned from others. You start out as a history major, correct? Then ends up, I don't know how you got into Bridgewater with that degree. Then at Bain, right? And then obviously running your own firm. And I'll let you go from there. Thanks.
Great. Well, thanks. It's great to be here. This is such a fun group. I've learned so much from all these presentations. I'll start with a story from Ken Arrow, who was the youngest economist to win the Nobel Prize. But during World War II, Ken Arrow was in the weather service, and he was tasked with producing long-range weather forecasts. Is it going to be raining in France 6 months from now? Will it be snowy in Siberia in May? These sorts of things. And after a few months of work, he realized that his forecasts were no better than an almanac. So he wrote in, he said to his commanding officer, producing long-range weather forecasts just isn't a solvable problem. You should use an almanac and fire everyone in the weather service. It's a waste of resources. And he received a message back, and it said, sir, the commanding officer knows that the forecasts are worthless, but he needs them for planning purposes. And I think there are many of us who have worked in the investment business any of us who have ever built DCF models or LBO models or almost any other type of fiction in Excel, know exactly what I'm talking about when I say planning purposes. There's another wonderful story about Greek ship owners. My colleague Sam Hansen wrote a wonderful paper about Greek ship owners. And there's an interesting phenomenon in the Greek shipping industry where when shipping rates are very high, ship owners go out and they look at their fleet. The typical Greek ship owner says, well, gee, if I had 10 more ships, I could be making so much more profit. How much does it cost to make a ship? Go get the data from the Korean shipyards. They plug it into Excel model and say, holy smokes, it's like a 35% IRR to build a new ship right now. I need to go out and build some new ships. So they go and they order the new ships. And then 2 or 3 years later, because that's how long it takes for a Korean shipyard to build a shipping vessel, the ships arrive. And the ship owner says to his captains, how are the new ships doing? And they say, oh, we have bad news to report. Shipping rates have cratered. They say, well, how have shipping rates cratered? We underwrote a very high level of shipping rates. And they say, well, sir, there's been a glut of new deliveries on the market. I said, a glut of new deliveries on the market? How did that happen? And said, well, it turned out that when we ordered those new ships, all of our competitors also ordered new ships at the same time because they ran the same models with the same shipping rates, and then when they all got delivered at the same time, the market was oversupplied. And Sam calls this competition neglect. You run your own analysis, but you neglect to think about all the other people that are doing the same analysis. And I think this is such a wonderful analog for markets where we're trying to make our own forecasts for planning purposes, but we're often neglecting to think about the fact that we are playing in a competitive market, that our analysis is probably not all that dissimilar to the analysis done by our competitors. And this competition neglect can extend not just to investors who fail to think about efficient markets, to fail to think about our competition, who fail to think about how investing isn't about analysis but about meta-analysis, but can also be true in a business sense. I think AI is such a wonderful example of this. You think about all of the companies building these foundational AI models, all thinking that they are going to be the winner in the AI race. And yet they're spending massive amounts of money on NVIDIA chips. I don't know what the depreciation schedule on a NVIDIA chip is, but it can't be that long. And data centers, and all forecasting that they're going to be the winner in this wonderful new market. But what's the probability that they, in fact, are suffering from competition neglect, failing to factor in the potential for their competitors to also own share in this new market? Now, Robert Shiller won the Nobel Prize just recently for, in large part because of a paper he wrote about what he calls excess volatility. So if you think about the net present value, the value of a stock is equal to the net present value of its future cash flows, discounted back to the future. The only problem with this, of course, is that we don't know future cash flows and we don't know what the right discount rate would be. It's a problem. Schiller points out, however, that if we go back to any period in the past, say the 30s or the 40s or the 50s, well, we actually know what future cash flows were from that point, and we know what discount rates were. So we can figure out the exact value of a given stock or the market at a given time and conclude what the fundamental value was at any time. He then compares the fundamental value to what the actual stock price was. And what he finds is that changes in fundamental value can only explain between 5 and 20% of market volatility. The rest he calls excess volatility. He doesn't know how to explain it. So markets are excessively volatile. What explains this excess volatility? There's an obscure economist at Stanford who no one ever cites. So there must be some problem with this work, but I like one of his theories, so I'll tell it to you because it resonates with me. His name is Mordecai Kurtz, and he has a theory he calls rational beliefs. And his theory is that when you think about valuing a stock, for example, we often hear, oh, the facts are all priced in. Everybody knows the information, it's all publicly available. Everyone knows what it is. It's all priced in. But what Kurtz points out is that everyone has a different pricing function. Right? Everybody interprets data in a different way. Right? Think about almost any political debate we have and how frustrating those can be. Right? You say, oh, well, what do you think about tariffs? What do you think? Are they going to be good for the economy, bad for the economy? Are they going to go up? Are they going to go down? What's the purpose of them? Right? We all have different opinions, even though we're operating often from the same set of facts. This is sort of an intrinsic thing about human nature and our own dissonant set of values. But what Kurtz points out is that the only way in which one figures out which rational beliefs were wrong is when the future unfolds and all of the alternative futures that could have happened are foreclosed. Now, you don't find the words forecasting errors in many economics textbooks, but any of us who have ever invested money know how frequent and how common, and in fact, how important and essential forecasting errors are to our day-to-day life. No one who's ever built a model or anticipated what next quarter's earnings will be has lived without a forecasting error or understanding its role in their investment process. So what Kurtz proves is that this theory of rational beliefs, of this dissonance of potential futures foreclosed, and then people adapting their forecasts to adapt to that new information is in fact what explains so much of market volatility. And it's this process also which drives so much of what goes on in markets, right? We are constantly watching this tension between expectations and reality, between forecasts and surprises. There's a study I did recently of Japanese companies, and Japanese companies are required to issue guidance 1 year forward. So every April, every Japanese company issues guidance for the fiscal year ending the next March. And it's a wonderful data set because it's complete. Every company has to do it. And you can look at their earnings and revenue forecast. And so what I did is I took this universe and I divided it for 25 years into companies that thought they'd have high growth, medium growth, or low growth. And then I said, well, what percent of the time do they actually get this right? Roughly splitting into these three groups. And it turns out that the typical CEO of a Japanese company is about 50% accurate at sorting into one of those categories. Now, 33% obviously would be random chance. So they're better than random chance, right? They're making good forecasts, right? 50% accuracy, right? But it's sorting into one of three categories, but that's pretty good actually. So you'd think, okay, well now there must be some valuable information in those forecasts. So you say, well, what happens to the stocks prices of the companies? You now a 3x3 matrix, what happens to the stock prices? Well, if you have a company that forecasts low growth and experiences low growth, the stock does a little bit worse than the market. Why a little bit worse? Because it was a mediocre outcome. Yes, they told us it would be mediocre, but it ended up being mediocre, and so no one's all that happy, and if the market went up 10, maybe you went up 6 or 7. That's 50% of the time. But the other 50% of the time, that company that forecasts the mediocre outcome actually has a good or very good outcome, and the stock goes up a lot. Conversely, when you look at the stocks that the CEOs forecast to have very high growth, 50% of the time they experience high growth, and those stocks do better than the market. They do better than the market because they forecast a great outcome and they achieve that great outcome and they're rewarded for it. But 50% of the time, they experience medium growth or low growth, a negative outcome. And in those cases, the stock tanks. And so if you multiply the 3x3 matrix by probability and outcome, you end up with every single box in the matrix being almost exactly the same in terms of total return. All of that forecast, because of how surprising the world is, even that relatively accurate forecast ends up being just noise when it comes to market returns. Now think about how much harder of a problem when you're saying, oh, I want to predict 2 years. Well, then you're multiplying that 50% by 50%, right? Or 3 years, 50% times 50%, right? Your accuracy rate is going down. And if there's one observation we have about forecasts, is that it's easier to make short-term forecasts than medium-term or long-term forecasts, right? If you can't predict the weather tomorrow, you probably can't predict the weather next week. If you can't predict next week, you probably can't predict next month. If you can't predict next quarter's earnings, why should you be able to predict 2 quarters out's earnings? And if you can't predict 2 quarters, why should you be able to predict 4? If you can't predict 4, why should you be able to predict 3 years? In fact, there's some very interesting research that shows, by Andre Schleifer at Harvard, that shows that long-term earnings growth forecasts, sort of the residual, you take out the 1 or 2 year and then look at what's included as the sort of out years forecast. And there was a speaker earlier who was talking about what percentage of the net present value tends to be embedded in that long-term forecast. And it's usually quite high. That is actually inversely correlated to stock returns. So the more optimistic people are in the out years, the worse the worse those stocks end up doing. And so my view, what do we do in response to this? I say that I think the first thing is to start, I like to think about starting from the premise of what I call future nihilism. Right? Imagine that you know nothing about the future, that it is impossible to predict the future. This is future nihilism. And if we start from that point and say, well, then what would I do? If the future was unpredictable, what would I do? If my model was complete garbage, what would I do? And I think that as a provocation for thought about your own process, whether that's an investment process or a business decision-making process, is a very fruitful place to start. Start with future nihilism. And then from there start to say, well, actually that's not totally true, right? We are not actually future nihilists. There are some things we can predict, right? Just think of those Japanese CEOs. They're not 33% accurate, they're 50% accurate, right? So we are not future nihilists. But let's understand first what we would do if we were, and then start to say, well, what are we confident we really can predict? How can we prove we can predict it? Because it turns out that so many things are unpredictable, and yet because we need these predictions for planning purposes, we never go back and interrogate the accuracy of our own historical forecasts. The other prompt towards, I think, better decision making, in addition to future nihilism, is to start and to think, again, meta-analytically, to think that I'm betting against hubris, and that is to say, let's look around and think not what am I doing, and that's why I love the presentation on technicals, because one of the things it's pointing to is let's not think about what we believe, let's try to decipher what others believe, right? How do we think relative to what others believe? And look for the places where people either are most hubristic, most optimistic, most confident, where there's a greatest consensus, or the opposite, where people are most pessimistic. And I think the greatest risks in markets, and indeed in business, whether that's the Greek ship owners or other examples, comes from correlated beliefs. When everybody thinks the same way, you're in a bad shape for an future investment. I will end in a second because I want to take questions, but I wanted to share just 2 or 3 examples of where I think correlated beliefs are greatest right now. I'll take 2 very brief ones. I think one is private markets. We are living in peak private markets. Private equity, private credit are so overbought, so overowned, and the amount of capital that's been flushed into them, with allocators taking up their allocations from 0% in 1980 to probably 20% in 2010 to 40% today, almost across the board. And as that new money came in, you have to remember that probably 50% of exits are sponsor to sponsor. And so a rising tide really does lift all boats, because if Fund 8 is $8 billion and Fund 9 is $10 billion and Fund 9 can buy from Fund 8, maybe right, they're 2 different firms, right? But what you see is the valuations continue to go up. The second thing was the increasing availability of private credit. And I think private credit is just about the stupidest thing anybody's ever come up with. Rapid innovations and expansions in lending almost always end badly. And I think even the story is so obviously flawed, right? If you had a friend and they come to you and they say, hey, gee, I want to get a mortgage, but gosh, the regulators have really gutted those banks. And they're not allowing the banks to make any smart mortgages anymore. And so I want to arrange a proprietary mortgage with you, a private mortgage, and I'll pay 12% per year. and I've never gone bankrupt. I'm a perfect credit. You'd say, well, there's something wrong with you. Those banks, right? The banks are not total fools, and they have done lending for a while. And maybe I probably shouldn't give you that mortgage. But I think people take off their efficient markets hat when they enter the world of credit. They think that yield equals return. They fail to think about bankruptcy risk. They often have competition neglect, right? That proprietary deal probably isn't that proprietary, and there's a winner's curse. And private equity, I think, I think these things are becoming more apparent that we're at peak. When Yale is trying to sell and can't, that's usually a bad sign. But I think that the illusion of managerial expertise, how did your buddy who spent 4 years, at Deutsche Bank's industrials team suddenly become really good at running software businesses, right? You're like, I don't know, right? Like, he probably isn't improving that Blackstone sold the business to KKR and that guy is on the team that then improves it before they sell it to some other private equity firm, right? A lot of these things sort of boggle the imagination, yet have become articles of faith among allocators. I think on the pessimism side, one thing I'd encourage you to think about, and I said that we can't predict the future, but some things are so reliable that we can predict them, and one thing that we can predict is that in the next few years, I'm not going to be any more specific than that, we will experience an economic crisis, right? We will experience another time when the tide goes out, where recession strikes, where bankruptcy rates spike. And the question I would put to you is that no matter what you're investing in or no matter what it is you do in business, that will probably be not only your greatest challenge, but your greatest opportunity. The greatest bargains, and whatever it is that you do will come then. It'll come surprisingly. You won't have anticipated it. You won't know the cause of it, but all of a sudden, everyone in your industry will panic, and there will be fire sales. And the question is, what will you do? And so I think just as we think about future nihilism, we should also think about planning for anticipated events that we know will happen. Right? We don't know what will cause them. We don't know when it'll happen. We don't know precisely how it will impact. But do you have a plan? Right? Do you have a set of things that you should go out and do the next time a crisis strikes? When there is a recession in your industry, when office prices go down 90% or whatever it is that you're investing in, do you have a plan for what you're going to do? Do you have an action that you're going to take? And I think that's a way to think about how do you counter consensus pessimism. When correlated beliefs turn into correlated panic, will you be ready to take the other end of the trade? So I'll stop there.
Rob? Just when you talk about the idea of zero nihilism investing, or zero hubris investing, if you will, and you then say, okay, now add back from that. So if we embrace that, all of our views in terms of predicting the future are equally uncertain and likely to be inaccurate. How do you figure out which ones to add back? If you think about starting at zero and then adding back, and which ones to truly embrace, like how do you risk stratify the confidence you can have in your predictions?
Yep. So I think there are a variety of sort of mental heuristics, right? I think the first is one default assumption is that the world follows a random walk, right? Obviously, mean reversion is another, but I think there's less evidence for that than that the world follows a random walk. What is a random walk? It just means that whatever is happening today sort of continues, right? If a company makes 100 million this year, it's going to make 100 million next year. You're not forecasting growth. You're not forecasting decline. You're saying the world's not going to change. What would you do in that case? Well, you'd probably buy stocks with like 20% dividend yields because you'd say, well, I'm going to get 20% dividend yield forever, right? And conversely, you would avoid completely things that had negative revenue and negative profit and were valued at 20 times imaginary numbers, right? And that actually isn't like a bad heuristic, but then you'd move from there and you'd say, but the things that have 20% yields have 20% yields because they're about to go bankrupt. So if we factor in a bankruptcy rate prediction, so you start to sort of modify and go down the logic. I think the other intuition comes from Phil Tetlock, who was referenced earlier, who talks about use of base rates. Or historical probabilities, which is sort of a wonderful framing, right? So you don't say, hey, is the U.S. going to go to war with China next year? You'd say, in how many years of the U.S.'s existence when we weren't at war, how many of those years did we go to war? And we come to a number that's sort of like 1 out of 75. And you say, I don't know what the chances are, but it's probably something like 1 out of 75. So that use of historical probabilities can give you another reference point. So I think it's start from we can't predict the future, then say, well, what if the future follows a random walk? And then next go to what do the historical base rates say? And that'll get you pretty far down the path of everything we kind of know about forecasting. Yep.
So I agree with you that something probably blows up in the next few years. but one of the things that's been interesting since '08 is the compartmentalizing of the market and of assets. And it essentially, about every 2 years, something really blows up. Every 2 years, it just doesn't blow everything up. And how do you, what, do you have any thoughts on that? And, you know, sort of why doesn't that continue? You know, I mean, just, you know, regional banks blew up 2 years ago. 2 years before that, industrials blew up. 2 years, you know, we had energy in 2020. I mean, something really big goes down 50 to 60%, not every 2 years.
Yeah, and I love this as sort of a market. I think of myself as like an applied historian, right? Because I love base rates. So let's study history and see what we can learn from it. And I think one of the things that you learn from history is that as nice as statistics are, it's humans that drive events and events that drive markets and create the statistics. And so we can't absent ourselves from history. And the specific facts of what happened are actually very important. And the set of specific facts that defined the last decade, or really the last 15 years, are that we have lived through a technological, and are living through a technological renovation, in a technological revolution that is a probably once every 50 to 100 years type event, right? It's like the railroads or the introduction of the jet airplane, right? This is as big as that and as transformative. And all the companies that have, almost all the companies that have been participants in driving that revolution have been American, and many of them have been publicly listed. And so we've lived through a period where all this novel economic growth was coming from this, and it sort of made our country's economic statistics almost impervious to, you know, who cares if oil tanks? In fact, who cares about inflation? Because if your iPhone, you know, think about how inflation stats are calculated. Think about like the technology in a 2010 iPhone versus the technology in a 2025 iPhone. There's been massive deflation as a result of technological innovation that's happened in mobile, it's happened in software, it's happened all across the board. So we've lived through sort of this perfect deflationary high growth period, which was just sort of wonderful for all risk assets. I would argue that the greatest risk to that, of course, comes from AI. Because, well, AI is an amazing technology, it's clearly a worse business model. You think about Google or Microsoft or Amazon, they were about 10% as capital intensive as your median industrial firm pre-AI, and they're about 3 times as capital intensive as the median industrials firm post-AI. And I think, you know, again, NVIDIA chips probably depreciate pretty fast. And so all these same things that Greek ship owners and other owners of large depreciating assets have experienced, you know, massive booms and busts, are likely to happen to tech now in a way that tech had no risk of it happening 5 years ago pre-AI. So I think that's my greatest specific concern about the market.
Questions? Observations? I have one last question. Maybe we'll close with this one. You talk a lot about in the book, and even the title's Humble Investor in it, but it's this concept of humility over hubris, rules over dogma, and you've clearly applied that thought in running your firm and your decisions. Like, maybe just open it, like, how do you do it? What do you think about it?
Yeah, so I think this has driven me on a path from being a history and literature major and deep in the world of humanities to really a very quantitative investor today. And a lot of what I do is build software to invest in markets, which is very different from where I came from, but it followed the natural progression of my thought, which is I want to study history and learn from it. But it turns out the way you study market history is through econometric techniques, and the way that you then tell the computer to act is based on, you know, math and learning from data. So I think my sort of journey has been from sort of that humanities worldview to a world in which, you know, half the staff on my team is full-time coders, and all we're doing is reading and studying market history and then trying to code the lessons from that into algorithms that can trade the markets actually basically autonomously. So that's been sort of my course of intellectual development.
Yeah. Sounds like a good answer. Thank you so much.
Yep, thank you.